Live from Sydney, this is Insight with me, Stroud-Watts, where we dive deeper into the stories that matter with crucial context and sharp analysis. Well, President Trump's reciprocal tariff plans are coming down to the wire, with his team still said to be finalising the size and scope of the new levies. We speak to the head of the busiest container hub in the US about the impact of the tariffs on business and trade. Port of Los Angeles Executive Director Eugene Seroka joins us in just a couple of minutes. And as investors too clamour for clarity, we speak exclusively to Dibadj, who's the CEO of investment management firm Janus Henderson, about how his firm is handling the volatility in these markets. And to our top story, with President Trump's reciprocal tariff plan coming down to the wire, we still don't know details, including rates. Sources saying that the Trump team is still finalising the fine print just hours from a planned event in the White House Rose Garden. We're told officials have multiple options on the table, including a tiered system with flat rates for countries or a more customised reciprocal plan. Other countries are readying their responses. Canadian Prime Minister Mark Carney is promising retaliatory tariffs, including on the auto sector, if Trump goes ahead with new levies. China, in contrast, has been calibrating its response with measured actions that avoid blowback on its economy. And as we get into this tariff countdown, traders are grappling with how to position Asian stocks, mostly in retreat now. Fears of stagflation in the US also starting to come to the fore. And Avril Hong has more from Singapore. Avril.
Yeah, Heidi, I mean, it's quite remarkable how close we are to Liberation Day, yet no clarity yet on the tariff front. These deliberations between Trump and his team still ongoing, and traders are finding it hard to position. So we're seeing its stock benchmark in the region flat, as are U.S. stock futures, despite the gains overnight. Bloomberg Dollar Index also sort of moving sideways. Those stagflation worries you speak of after factory PMI showed weak demand and prices climbing. That's really the concern that's coming to the fore. And we saw the U.S. 10-year yield at one point overnight hitting 4.13, now hovering near the 4.19 handle. Now, flip the board, because this is really interesting. If you take a look at the concerns in the market, we're still seeing three strategists seen as among the most reliable of Wall Street's bulls. They have cut their targets for the year, but they still see the S&P 500 gaining ground before the year is through. The most bullish among them, Societe, is expecting 6,400 on the US benchmark. So from where we are now, that represents about a 14% climb. And this reflects how they maybe see a slowdown, but not a widespread meltdown per se. Flip the board again, and just wanted to put things into further context, because you take this along with what we're seeing in credit markets. They also seem to be largely ignoring the near-term stock market sell-off. If you look at spreads, whether it's high yield, whether it's investment grade. So the worry is, are they properly pricing in the risks? Does this turn into a sort of grey swan event, a risk that is known but largely ignored until it hits, especially given how Liberation Day, Heidi, might not represent this end of tariff uncertainty?
Avril there with a look at just how challenging these trading conditions are, and challenging too for those within logistics and shipping and trade, right? Let's bring in exclusively now Eugene Seroka, who's the Executive Director at the Port of Los Angeles. This is the busiest container port in the US, and I believe in the Western Hemisphere. He's a global trade expert and industry leader with more than 35 years of experience in the maritime sector. Gene, great to have you with us, and you're as well placed as anyone that I can imagine to sort of guide us through all of this volatility. I guess I should start off by saying, how are you feeling at the moment, and how well prepared do you think is the broader business?
Well, good afternoon, Heidi. Like most of the world, we're waiting for under 17 hours to come and some announcements to be made. That lack of uncertainty, or that uncertainty in the marketplace, has been dominating conversations across world trade and right here at home in Los Angeles. We saw the beginning of this last summer, which would have been during election season, where some large companies started to front load or advance their inventories into the United States in the event this administration carried through with its promise on tariffs. And now we're seeing that come to light. So we've seen peak season months for about 8 of the last 9. Cargo rushing through the gateway here in Los Angeles and neighboring Long Beach to get into market, hopefully to leverage down prices.
That front loading is an interesting one, and I do wonder, in addition to that, are you starting to see the impact on confidence now, even before the tariffs are being announced? Is there sort of less interest now that some of, the initial volumes have been pushed through?
Well, this is also very interesting because we look at some of the economic fundamentals here in the United States. Still very low unemployment rate. Open jobs are at 7.5 million positions, and other sequential numbers look pretty good. What's happening now is a forward look. Consumer confidence and sentiment dropping. Equity markets very volatile, as you follow every day. And folks just uneasy, not being able to understand at this point what really is going to take place from a policy or implementation perspective.
So to that end, is it even possible, what sort of modelling, I guess, or insights can you give into the potential, from best to worst case scenarios, given that by the sounds of it, pretty much everything is still on the table, as you say, just hours away from an announcement?
All right, we've had some experience in this area where during the first administration, we saw tariffs put in place and new trade policies in the first quarter of 2018. So much so, and these were much narrower, that by the end of 2019, our business dropped at the Port of Los Angeles by 16%, basically because cargo rushed in before tariff milestone dates and then dropped off precipitously thereafter. Probably going to see the same right now. A lot of rush up, and now folks waiting to see what's going to happen. I see right now that inventory levels will continue to creep up, and by the second half of this year, if everything comes to hold, we'll see a drop in cargo simply because so much product has already been shipped into the United States.
What does it mean for costs and also negotiating leverage? We've seen different companies deal with this in different ways. For example, the likes of Walmart reportedly pressuring their Chinese suppliers to, eat some of the costs. Is that sort of strategy feeding through to port fees, to shipping costs and other sort of broader logistics spend?
Yeah, you see three things happening right now. One, importers here in the United States negotiating with their Asia suppliers, mainly in China. Still, nearly half our business emanates from China. Second, how much can the importer take on as far as these additional costs, although it will cause margin compression? And then thirdly, what can they pass on to the consumer here in the United States, which will only edge up inflation once again? None of these options are really great. But from what we've talked about here on the ground to importing and exporting companies, folks are just trying to understand what will be implemented so they can navigate in and around it, knowing that there probably will be many more negotiations to come.
There's also a proposed executive order that we've been talking about for the last few weeks that would put pressure on Chinese-built ships and their ability and the cost to dock in the US, right? What's your assessment around that, how it could be expected and the impact on the business?
A lot of response to this so far, Heidi. And just last week in Washington, 2 days of public hearings from various interests in and around the supply chain, the workforce, and others. What we've heard directly from the ship owners, the liner companies, is that if this is implemented, it will cause them to call fewer ports, meaning that if they've got 4 ports in a normal rotation on the East Coast of the U.S., they may choose 1. Here on the West Coast, the gateway of Long Beach and Los Angeles, which accounts for 40% of our nation's imports, may be one of the only port calls remaining. Smaller ports such as Oakland and others up the West Coast of the United States may be bypassed. And that would be decimating to those communities, workforces, and the local economies. More to come on this.
What do you see the implications? I mean, we talked about, obviously, tariffs. We talked about, potentially structural changes to global trade as well as this executive order. What do you see as the broader implications when it comes to container ship rates, right, which, we've seen a really turbulent time just over the last 10 to 20 years already?
And no shortage of headwinds in the last couple of years, as you know, too, Heidi. We've had the drought conditions in the Panama Canal, which seem to have normalized, protracted labor negotiations on both coasts here in the United States, and the ongoing security concerns in the Red Sea causing Suez Canal crossings to plummet over the last couple of years. Now, fortunately enough, because of the longer transit times around the Cape of Good Hope in Africa, additional capacity, the new build variety, has been taken into those routes. So we don't see the supply-demand curve shifting too much at this point. We'll see how long that continues. But with these disruptions, those assets are mobile. And if products start dipping from China but moving or migrating to Southeast Asia, the liner shipping companies can mobilize those vessels pretty quickly. At the same time, we'll have new builds coming out with dual fuel capacity and other key attributes. But for the time being, I see that supply-demand curve remaining pretty level, meaning rates will stay where they are, if not inch up just a little bit.
So we know that China accounts for about half of all ship deliveries globally. We know that something like 6 out of 10 builds at the moment are in Chinese yards. President Trump has clearly taken this as a matter of priority. Do you think it is possible or even sort of something that you would encourage to try and revive, you know, a golden age in American shipbuilding?
Yeah, I think this is an interesting question, too. And having diversity in manufacturing, choice for those who are purchasing and making investments in capital products is very important, just as is rules-based trade and protecting American jobs. But to stand up a shipbuilding interest like that across the globe is going to take time, more than a decade, maybe decades, plural, to really launch. Now, there may be smaller ships that can be built. Certain crafts will come out pretty quickly, but this is a huge undertaking to shift the world's balance with one policy.
I can imagine that if some of these measures come through, including the EO, there could be enormous potential for congestion, disruption, you know, bottlenecks. Is that something that you're worried about for LA, which is, of course, has scale on its size?
Right. We watch that every day, and we learn so much, Heidi, from the COVID time, where at one point we had 109 ships backed up at anchor. This past peak season in 2024, we moved more cargo than we did during that time period in 2021 or 2022 and didn't have one ship backed up. And I'd like to say we learned a lot, but we also worked a lot closer across stakeholder groups, tried to make sure that our data-driven approach really got results and folks were all pulling in the same direction. We're running right now at about 65 to 70% of effective capacity here at the Port of Los Angeles, so there is room to scale. We have a digital port community system, the Port Optimizer, that tells us what cargo is coming our way some 40 days in advance, so we can adjust that great skilled workforce and our land machinery. So I think we've got a better look at this than we ever have, but not resting on our laurels. We've got to stay ahead of all these changes every day.
Is the government, are officials from the Trump administration taking consultation from private sector voices such as yourselves? Do you think that recommendation, sort of levels of recommendation and imploring are being taken on board?
Oh, it's early days still, but we had a delegation from Los Angeles led by the head of our Chamber of Commerce and various business leaders meeting with administration officials in Washington up and down, as well as electeds. And just last week, as I mentioned, with the open forum, 2 days worth of discussion around the China-built ships, I think we're starting to see some dialogue go back and forth. And I can attest to the fact that private sector companies are engaging the administration to share their virtues and benefits in light of policy considerations.
Where do reconfigured shipping flows and supply chains benefit, do you think? There's been some talk about redirection to Canada or Mexico, for example. Globally, can you think of kind of the winners and losers out of this?
Yeah, it is really early to tell, but one thing that we have to keep in mind is that with these policy changes and the directives that are coming out, the changes in fiscal policy when it comes to these tariffs, we've got to make sure that as a country we remain competitive. And whether it's our own harbor maintenance tax that covers only waterborne import to the United States, there may be ways to go around through Canada or Mexico. That's being addressed with a land border process as well. So overall, what we see is a continued migration of a China plus one strategy, for example, where at its peak, about 57% of our business here at the Port of Los Angeles was with China. Today, it's just under 45%. Most of that migration of sourcing has shifted to Southeast Asia. And while speed component has always been our go-to strategy in the marketplace, we're starting to see more and more capacity from liner shipping vessels, and nonstop services emanate from Southeast Asia. So America's got to stay competitive. Again, 90% of trade moves on water, and this gateway has been the strength of our nation's international trade now, being in the #1 position for 25 consecutive years.
You've talked about, all throughout the supply chain and the voices that you've heard from retailers to exporters to suppliers to shippers, of course, and the mood music is uncertainty and confusion. Do you worry that this embedding of a lack of confidence is something that's going to be very difficult to reverse, even if policies change down the track?
But that's also going to be unique to us as well. The #1 economy in the world, driven mainly by the American consumer, about 70% of our GDP driven by those who purchase at the retail level. But that competitiveness is key because folks have to want to trade with us. And we have to find that rules-based trade that allows us to continue to flourish. We want more manufacturing work here, too. And what's been a little bit off of the beaten path as far as discussion is that while we talk a lot about finished goods coming through Los Angeles to the rest of the country here in the United States, equally as important are the inputs for the American manufacturers. It's about the same amount of cargo volume that flows through here with parts, components, and peripherals. And to help drive that American export, I think, is what we have in front of us in these bilateral negotiations. It will be an opportunity to promote the ingenuity and production capability of American exporters, including our agricultural sector.
Eugene, really great to have you with us today. Eugene Seroka from the Port of Los Angeles as we continue to count down to Trump's tariff announcements. And coming up on Insight, the CEO of Janus Henderson Investors joining us with his outlook when it comes to who wins, who loses from Trump's reciprocal tariffs in the Asian region. That exclusive conversation is next. This is Bloomberg.
It is a maximalist approach, and at least right now, if this reporting is correct, it doesn't look like it's so much country by country. Maybe this is the floor, but yeah, no, this is a much bigger hit to tariffs, I think, than most people were thinking, presumably the Fed even a couple of months ago.
Former Federal Reserve Vice Chairman Richard Clarida there speaking with Bloomberg about President Trump's trade restrictions. Let's get some market analysis now with our next guest. Joining us exclusively is Dibadj, who's a CEO at Janus Henderson Investors, with assets under management as of February of around $389 billion. Ali, really great to have you with us, and such a, I guess you could say, exciting time, certainly a volatile time, and a time, as you say, that really kind of you need to be on top of what these markets are doing. What's your approach at the moment as we have, either people that are opportunistic, trying to find hedges against the volatility, or just sitting on the sidelines altogether until we know more?
Heidi, well, thanks for having me. Great to see you. I'd say a few things. You're exactly right. This is a time of enormous uncertainty, enormous complexity. The time frame here, a few hours left before we hear a little bit of news, is certainly on people's minds. But don't forget that complexity, that uncertainty, also, on the flip side, is opportunity for investments. We really work very, very hard to make sure we're helping our clients, particularly in these uncomfortable moments at Janus Henderson, to deliver on their needs, to deliver on opportunities that they can identify. Remember, we have about 90 years of history in seeing these ups and downs and tariff wars before. We have 340 people at Janus Henderson who are investors, who find these opportunities, and 500 plus people who interact with clients and try to help them with these uncomfortable times and discover where those opportunities are. And there are plenty of opportunities out there, even among this complexity and uncertainty, to deliver better yield, better returns, both from a hedge perspective, but also an opportunity for upside for our client base.
How reactive do you have to be in this environment, right? Because even kind of traditionally short tenured positions seem like they might be a little bit too long, given that sometimes from minute to minute you can have headline and news flows that change things quite dramatically.
Yeah, I think you do have to think about the time frame of things, and I would break it up into two pieces. First of all, one can't just let the tide lift all boats. Being passive as an investor right now is absolutely the wrong idea. That is not what you can do. You have to be active. You have to be very dynamic. And again, that's what asset managers who are active like us do all day long. Now, that being said, one really looks at themes that are a little bit more immutable or can break through this noise, can break through this uncertainty, and over time will certainly deliver for us. One of the themes that we talk about with our clients for sure is to shift a little bit of a weighting, not fully, but a little bit of the weighting from an investment perspective from the U.S. to outside the U.S. We see enormous opportunity in Europe, for example. Our European teams of investors are extraordinarily excited about the supply chain changes that are happening and benefiting them, the political changes that are happening to benefit and bring together perhaps Europe over time. So Europe comes up on the radar screen quite a bit. Latin America, for sure. The Middle East, for us, both in the public markets, but also in the private markets, we see enormous opportunities. So outside the U.S., for sure. Now, there's another theme that certainly breaks through this noise, breaks through this uncertainty over the long term, and that's one of innovation. There's no question innovation will be able to offset over some periods of time some of these tariff volatilities and oscillations. Innovation, for example, in technology. Our global technology leaders teams are very focused on finding things that fit into new needs of technology, new needs of demographics, new needs of lifestyles, and finding investment opportunities for our client base that's out there. Healthcare is another immutable theme. We find that obviously demographics are changing. We're obviously getting much older, but you intersperse that with technological changes in biotech and healthcare, longevity, et cetera. And our global life sciences teams, for example, find really interesting opportunities around the world, agnostic of location, that deliver great upside for folks. A lot of that actually circles around also not just the large cap companies that we certainly invest in, but the small and mid cap companies around the world that are perhaps less disrupted by the supply chain changes and tariffs that happen because they're much more localized in a region or have innovation that offsets a lot of, again, this noise. So we see a lot of opportunity in innovation as well. Now, again, and you put the clip up before talking about the Fed rates in the U.S., you also see fixed income becoming extraordinarily relevant in this marketplace. We believe that securitized around CLOs and broader securitized investments offer enormous opportunity for upside and stability for our clients. And if you mix the equities part and the fixed income side, a balanced portfolio, a balanced fund, for example, like ours or some of our competitors, is quite an opportunity right now to get the ballast of equities and fixed income and the upside of equities and fixed income as well.
Is this less of a declaration that American exceptionalism is over from an investing point of view, or is it simply just more selective?
Look, I think it's both. I definitely think that the overweight that the U.S. has had is certainly being put under pressure right now. Investors want a certain environment. They want to have the opportunity to actually see companies and innovation and technology play out in the way that they want it to play out, in the way that the research would suggest it does. And I think you're seeing a phase right now in the U.S. which is obviously a little bit more uncertain, obviously a little bit less stable. So I do think there's a shift from U.S. to elsewhere in the world. But within that, again, you can't be passive. One cannot just say, oh, I'm going to invest in this region in Europe or UK or Latin America or Middle East. You do have to be selective across the board.
Right. Ali, hold that thought. We'll be back with you in just a moment. Ali Dibadj, who's the CEO at Janus Henderson Investors, is sticking around with us. Much more ahead. This is Bloomberg. Welcome back. You're watching Insight. Chinese Foreign Minister Wang Yi is blasting Trump's tariffs on China as unjustified bullying from the US. Let's bring our Chief North Asia correspondent, Stephen Angle, who joins us in Hong Kong. And what are you watching when it comes to, is it the 11th hour? Well, certainly we're just a few hours away from the announcements of these tariffs.
Yeah, for a White House that is pretty much telegraphed what it's going to do, we are short on the details on how it's going to impact one of its biggest trading partners, of course, the second biggest economy in the world, and that is China. We already know the Trump administration has imposed 20%, 10 plus later another 10 on China, in addition to what was already in place because of the fentanyl issue. And that is something that, as you just mentioned, the foreign minister Wang Yi, probably the most outspoken of all the Chinese top officials, speaking to a Russian news outlet, essentially saying if the United States really wants to fix its fentanyl issue, they should come to the table and in good faith with the United States, with China, I should say, and on equal footing and discuss this. He called them unjustified 20% tariffs. And again, this is going further with the unknown of perhaps reciprocal tariffs against value-added tax subsidies, rebates that essentially the Chinese government gives its exporters, and also other non-tariff barriers that might give the Trump administration the justification to go further. We simply don't know. But Bloomberg Economics did a nice breakdown. If there is, in the most severe case, another 20% on top of what has already been in place, that would take the average tariff of U.S. on Chinese goods into the United States to 52.8%. That is getting to that, some would say, worst-case scenario that Donald Trump threatened on the campaign trail of 60% across the board. So we're waiting, and the Chinese have been instructed by Xi Jinping to basically project calm, keep calm through this, but I will bet your bottom dollar that the authorities in Beijing have their finger on the button for retaliation if indeed those accelerated tariffs come down the pike later today.
We're also waiting for the USTR review of the US-China Phase 1 trade deal as well. How does that potentially complicate or kind of set the scene for possible trade talks?
Well, it's going to be very difficult for the USTR to conclude in its review, which Donald Trump essentially ordered on day one when he returned to the White House. It will be very difficult for this review to say that Beijing has followed through on the pledges to buy an additional $200 billion worth of American goods. A lot happened after that Phase 1 trade deal was reached, and then the end of the Trump administration version 1.0, because the pandemic happened. So China did not fulfill all its obligation. Now, how is Trump going to latch on to that report, which we don't have the details of yet, I might add? What's he going to take from that report as a basis for potential negotiations down the road to mitigate, for China to mitigate future tariffs, or for Donald Trump to say, this is the reason why we're going to be adding more tariffs and why we have justification for the current additional 20% on fentanyl. So fentanyl issue is being lumped into all the trade issues for the overall tariff plan that Trump has, but he hasn't outlined exactly what the next plan is going to be. So that's why we're all kind of waiting until, what, later today in the United States, Liberation Day, or as Stephen Roach told me, that's of course the former Asia-Pacific chairman of Morgan Stanley, he told me last week in China, he's calling it ground zero, or likened it to ground zero. So we'll have to see.
Bloomberg's Chief North Asia correspondent Stephen Angle there. Well, Ali Dibadj, who's a CEO at Janus Henderson Investors, is still with us. And Ali, thanks for sticking around for us. It's interesting, we've seen this sort of fairly measured response policy-wise from China in terms of how it's sort of retaliated against the measures from the Trump administration. What's your gauge of how the economy domestically is doing now and some of the opportunities that might arise as a diversifier from the US?
Okay, I think, again, as Steve said, we're waiting for a lot of information to see how the impact might be. I think if you think about it from a U.S. perspective, you're clearly seeing some slowdown and some trepidation. The forward-looking measures, whether it be consumer confidence, whether it be actually credit card data, would suggest things are slowing down. And we'll see if that's short-term or long-term in nature, but certainly something that has given us all pause. I do think, just going back to what Stephen was saying, that China in the crosshairs of what we're going to hear in the next few hours is certainly going to be part of the case. I think, look, from an investment perspective, it's very difficult to bet against China over the long term, right? Any country that has 1.4 billion people, that has such a storied history, that has great innovation, that has a policy from a governmental perspective that's supporting that domestic economy, I think is very, very difficult to bet against. But that also means that what we'll hear probably in the next few hours is going to target much more tariffs from a China perspective, and perhaps broadly, in terms of percentage of tariffs, but also more surgically in particular areas. AI is one that comes to mind. Right now, there's clearly limitations on what China can do from an AI technology perspective on microchips. We've all heard of DeepSeek. We've all heard how that has played out. But the reality is that the next generation of chips, for example, from NVIDIA, the Rubin Ultra chip you may have heard of, that's second half of 27, I think, coming out. That's 100 times faster than the Hopper chip today that's been used to create DeepSeek and everything else. If there are limitations on that, that does change the dynamic in China from that domestic environment, from that innovation. And I do think that you're going to see both broad-based tariffs, but also surgical areas of focus from this administration in the U.S. To try to make sure that competitively some areas of other economies are impacted negatively.
If you are sort of all in when it comes to the exuberance that we've seen starting from the DeepSeek news, and of course it feels like that momentum is now building with so many other announcements in the AI space in China, what's your preferred way of having exposure to that?
Well, look, I think there are two areas, first of all, to think about. The first one is, without a doubt, we have to see how the tariffs will impact this, particularly on the AI side. But that doesn't mean innovation is, in China, only limited to AI, right? There's significant other innovation there. Our global life sciences teams invest significantly in biotech, some of which are Chinese-related companies. Our technology teams, global technology leaders, invest in areas that have China innovation that's related there. We all know about EV. We all know about the robotics that are playing out there. They're very distinct areas that you can invest in, both from an equity perspective, but also from a fixed income perspective as well from those areas, whether it be sovereign debt in our emerging market debt fund, what have you. So there are very clear opportunities within China itself and the companies that are innovating and deriving a lot of value in that way. There's a second element, though, which one has to think about, which is just because you're listed in a particular geography, I include China in that, I'd include Hong Kong, I'd include India and the European Union, for example. Just because you're listed there doesn't mean your exposure is only to there. You can have global reach. And that's really one of the things that our investors, the 340 that we have around the world, have local presence for sure. But think about the global ramifications of investing in a company that has the opportunity to improve many people's lives around the world. Just because they're listed in China or somewhere else doesn't necessarily mean they're a Chinese company or an Indian company or a UK company. They have opportunity to invest elsewhere. And that's one of the things that we very much look for as kind of diamonds in the rough oftentimes. You can't throw the baby out with the bathwater. You have to figure out those opportunities, equities, and fixed income as well.
Where else do you find those opportunities within Asia?
We think there's enormous opportunity, actually, if you extend Asia a little bit in Australia. We have an Australian fixed income business that sees great flows coming in from other parts of the world, looking for a little bit more stability, looking for perhaps a little bit of an offshoot of what's going on in China and Asia as well. And if you extend that for sure, we have a Middle Eastern capability that we just actually brought on board that is quite exciting, too. It's a private credit capability that offers credit to entrepreneurial ventures in the region of the Middle East. Now, there's a very close tie, as we all know, particularly between China and the Middle East right now. That's taking advantage of some of these entrepreneurial opportunities that we see and that we at Janus Henderson from our teams locally invest in and globally can advantage our 60 million end clients that we serve directly or indirectly around the world.
It's interesting. The constructive kind of call on Australia tells me that at the moment you want things to be pretty defensive.
Absolutely. I think you're right. I think there's a couple plays there. One is for sure higher quality, defensiveness from a supply chain perspective, defensiveness from an innovation perspective, so you can actually deliver things that are valuable to people. I think there's that element to it. I think there's a subtext to Australia and maybe some other parts of the world as well, and some of the companies we invest in, which is inflation. Likely inflation will be impacted positively, i.e. growing inflation here. And Australia, with its commodity-centric economy so far, also benefits from that. So I think there's two elements of it. Yes, defensiveness, but also inflation likely playing out here, given tariffs are going to be happening, not just in the next few hours, but reciprocity from other countries as well will drive inflation higher.
Are there opportunities that you see in emerging markets right now?
Yes, we do see them. Now, again, those come in two flavors. One flavor is you're really good in your local economy. You're doing very, very well there, and you're delivering for that market. But there's also other flavors, which we find more interesting, actually, which have innovation or direct changes that they're bringing to bear and disrupting an environment that also has global implications. So I mentioned technology on our Global Technology Fund. I've mentioned global life sciences as well, that we see opportunities that have both flavors. So regionally and locally very, very strong, and also globally. We see opportunities in China, as I mentioned. We certainly see opportunities almost peripherally to that in Hong Kong, but also in areas like Latin America. We see interesting opportunities there, for example, that have revolutionized the way retail comes to market. One overlay of all this, by the way, and you asked the question around emerging markets, is financial services, we think is an enormous kind of stability bet around the world. There's so much complexity in the world. There's so much change around the world. Financial services businesses, banks, but also asset managers like Janus Henderson should feel a really interesting opportunity here because they're desired by their clients. Our clients are asking us now more than ever, among our 500 people around the world who serve clients, what do I do now? And so we can help them think through that process. We're seeing enormous inflows from interest, and I'm sure that's for other of our peers as well.
Obviously, European markets is one that has benefited from the enormous geostrategic shift from Washington, right? Do you see further upside when it comes to Europe, particularly with that sort of German fiscal defense-driven rally?
Yeah, you raised Germany. It's a really interesting point. They did exactly the right thing at exactly the right time so far from a stimulus perspective. We're seeing, yes, opportunities in Europe. And that's not just Germany. We do think that one of the kind of ancillary effects of what's happening in the U.S. is other parts of the world are realizing that they have to band together. Perhaps Europe should thank the Trump administration for actually waking them up and getting together. You're seeing more of that from both an economic cooperation perspective, but also from a company underlying that. So yes, our pan-European teams believe lots of opportunity in continental Europe, but also in the UK. You're seeing the Labour government in the UK right now talk a lot more about growth than any of us suspected. I think that's going to accelerate over time. Talking about growth locally, but again, talking about growth of local companies that have global implications that companies like Janus Henderson can invest in and deliver for our clients from a performance perspective. Again, those are not easily found. We have to spend a lot of time fundamentally understanding this. Going back to the point, you have to be very dynamic in your investments. You can't just let the tide lift all boats or be passive. I don't think index funds work anymore. In fact, if we ran any of our portfolios like some of these index funds out there right now, clients would not be happy. There's too much concentration risk in there. So again, being very active, being very dynamic, using active management on equities and fixed income, private and public, we do think will bear fruit in this world of tumult, defensive and otherwise.
Ali, I don't think we've talked about India yet. Obviously, there's a few different strands going on there, from the sort of tariff exposure to whether or not this market sell-off and the sort of economic momentum fading has bottomed out. Do you have a strong stance when it comes to India, given it is one of the worst performers this week because of these trade concerns?
Yes, look, I think India remains a very vibrant region of the world. Again, hard to bet against anywhere with 1.4 billion people who are innovative and changing and have a desire and have a government that's backing them from a progress perspective. Look, our view on India and frankly the whole world order is that there are countries and regions of the world who are stepping into voids that are being created by, for example, the U.S. India is one of those areas for sure. The Middle East more broadly is one of those areas for sure. They're stepping into voids, making geopolitical realignment an opportunity from an investment perspective. You know, Heidi, one of the things that we spend a lot of time thinking about is how do we invest in a company that is aligned with the political environment of that region? It used to be, back when I was a portfolio manager, it used to be kind of not the right thing, almost unthoughtable, not thinkable to think about politics as an investment lever. Well, now it has to be. And now it has to be something in India, Middle East, and in China and other parts, just as you've been talking about with other guests as well. It has to be part of the investment narrative to think about the politics and the direction that that government is pushing for in different industries and how you can take advantage of that from an investment perspective. I think India, to your point, is one that, yes, has pulled back a little bit, and it may pull back a little bit more, but over time, it's stepping into a void that other countries, particularly the U.S., is allowing others to step into.
Ali, so great to have you with us today. We appreciate your time and your insights. Ali Dibadj, who's the CEO at Janus, Henderson Investors, as we continue to count down to those US trade tariffs. Well, coming up, Vanda Insights Vandana Hari joins us now with her outlook when it comes to the oil market amid threats from the US to impose secondary tariffs on buyers of Russian oil. This is Bloomberg. Get you to start trading when it comes to markets in India, and of course, as we've seen really reflected elsewhere across the region, we're not probably going to see any major bets at this point. Traders kind of avoiding big positions or ahead of that tariff announcement, which is now just hours away. We know that when it comes to these tariffs, it's probably more like what we don't know. We understand pretty much everything kind of remaining on the table in terms of options for the minute. The Sensex, we're seeing gains of about 0.3% there. This as markets in India really coming off some big underperformance this week as a result of these concerns over these tariffs as well. But we are looking at potentially that easing cash crunch could potentially limit the downside now. Taking a look at oil, we're seeing some pretty modest moves there, wavering really when it comes to conviction, focusing really turning, I should say, to the tariff announcements and sort of further away from President Trump's threat to impose secondary tariffs on buyers of Russian crude. Let's bring in some views now when it comes to where to for these energy markets. Vandana Hari, who's a founder at Vanda Insights. Vandana, always great to have you with us. And it is sort of this push and pull that we're seeing between this threat of potentially more sanctions on buyers of Russian crude, but also fundamentally the outlook for demand remains pretty bleak. So which is a stronger kind of factor here?
Hi, Heidi. So it's a pretty poor signal to noise ratio for the oil markets for the time being. And as you were mentioning earlier, what comes out of the White House this evening will impact the overall economic sentiment, which of course has a bearing on the oil demand outlook. But just to go back to the Trump threat to impose secondary sanctions on Russia, so far the market has shrugged it off. It's most likely a bluster. We know President Trump has been quite frustrated with President Putin sort of dragging his feet on signing a Ukraine ceasefire. The other thing to bear in mind is that a threat to impose secondary sanctions that he mentioned, 25 to 50%, secondary tariffs, beg your pardon, he mentioned 25 to 50%, which is pretty huge, is very different from secondary tariffs on Venezuela, which were imposed last week. So the Trump administration said any countries that continue to buy Venezuelan oil will face might face 25% Venezuelan oil will face 25% import tariffs. Now, Venezuela exports just about 600,000 barrels per day of oil. Russia exports close to 6 million barrels per day of crude and refined products. So I don't believe that that's going to go through. It's a threat. It's a bargaining ploy by Trump. But then, you know, the market has indeed the Venezuelan and Iranian sanctions, which it is keeping an eye on, because those are already causing supply disruptions.
You know, you say refiners can't kind of act on just a hunch alone, right? What are the worst case scenarios that the industry is bracing for in terms of expectations on these tariff announcements and the flow-on effects of them?
Yeah, so what we have seen is that Indian refiners have scrambled, and I suspect so have their Chinese counterparts, to try and secure barrels which would typically be from the Middle East, heavy, medium, sour grades, similar to the Urals crude that is exported by Russia. Just to hedge themselves against the eventuality, even if they are setting aside, for all practical purposes, the probability that Trump will proceed with those secondary tariffs against Russia, they can't take the risk. Especially India's, nearly a third of Indian crude imports came from Russia last year. China dependent on Russia to a slightly less extent, but nonetheless substantial at around 21% of its imports. China also gets nearly 40% of that via a pipeline from Russia, which will be hard for the U.S. to monitor if it were to proceed with those secondary tariffs. But you will notice the scramble amongst refiners. That said, they have been used to rolling with the punches, Heidi, because we've had several rounds of tightening sanctions against Russia. We've had sanctions against Venezuela, Iran. All in, it's just a very, very noisy and a challenging and unpredictable environment for refiners.
What is the outlook when it comes to the demand side, particularly when you take a look at major consumers like China and India?
So since the start of this year, we have seen oil demand outlooks being downgraded they were already pretty subdued towards the end of last year when we were looking out into 2025. Global economy was expected to be decelerating in its expansion. What has changed in the past 10 weeks or so that Trump has been in office is that the outlook for global growth has turned way more pessimistic, certainly for the U.S. and for, definitely as a ripple effect. And because of all the trade wars involving the major trade partners and economies, definitely the outlook souring for major economies around the world. So that has put a fair bit of downward pressure on crude prices. I expect that to remain the case. Now, of course, I know there's plenty of speculation and debate to what extent Trump waters down perhaps the reciprocal tariffs he's going to announce tonight. But, the case remains that a lot of tariffs have already gone into effect. A lot of countries are preparing retaliatory measures. So, this overall, it's not a good environment for economic growth, which doesn't bode well for oil demand growth. And within that, of course, China, we heard overnight from the CNBC think tank that they are expecting a mere 1% growth year on year in Chinese oil demand. And they've been pretty much on the mark so far. So, that tells you perhaps about 150, 160,000 barrels per day, some total increment in Chinese consumption, is not really looking good for global demand growth this year.
Vandana, really great to have you with us. Vanda Hari, who's a founder of Vanda Insights. Before we go a look at tomorrow's program, global trade experts Eshwar Prasad and Jennifer Hillman give us a deep dive analysis of President Trump's tariff announcements, which, of course, we'll get in the hours to come. We'll also be getting that market reaction on trade with JP Morgan Asset Management's Resha Rashid. That is it for Insight. Horizons Middle East and Africa is up next. This is Bloomberg.